So hello everyone, and I hope everyone is doing well in my Business 330 class. I hope everyone is staying healthy and separating from everyone and keep, using proper hygiene and washing your hands. So I want to talk about Chapter 6. We finished in class at Chapter 5, and I want to discuss Chapter 6, so I'm going to be making videos for Chapter 6. Chapter 6 is about interest rates and bond valuation. Okay, so bonds are debt. Companies borrow money, and they're called bonds or debt. Okay, I want to make sure everyone's clear about what a bond is. All right, so we're going to talk about interest rates here, right? Interest rate fundamentals, the term structure, the legality of bonds, what's called contracts or indentures, different types of yields, how they're priced. And of course, the most important thing is the yields and the price. And we'll talk about bond ratings, which, as you may have heard me mention, things called junk bonds or high yield bonds, and that all comes about because of these ratings. And there's many different types of bonds. And again, most important, we'll talk about bond valuation. The equation for a bond, and I'll show you in Microsoft Excel how to get the price of a bond. Okay, Microsoft Excel will come in very handy. All right, so what are interest rates? Oh, so before I begin, I want to make sure everyone's aware. I'm going to do these in about 10-minute bites because the file gets too huge, and it takes forever to upload it. And this way you can watch it, and there'll be several parts. Okay. There'll be like Chapter 6, Part 1, and Chapter 6, Part 2, etc., etc. All right, so in interest rate fundamentals, interest rates are applied to debt instruments or bank loans or your savings account. Everyone should know what interest rates are, right? It tells you how much you're going to get. And as you know, the Fed recently lowered the Fed funds rate, which is the rate which companies borrow from each other, to 0. And so there's many interest rates in all types of our economy. And how interest rates are determined by supply and demand. So right now, basically interest rates have been dropped to 0, okay? Because, and they're trying to increase the supply of money, okay? Because banks are in trouble and companies are in trouble, and they want to keep the economy going. Now, when you see the word interest rate versus required return normally refers to bank stocks, or stocks in general, or okay. So a required return is equities or okay. So inflation is a problem we all have to deal with in life, okay? And that's why you want high interest rates, because your goal is always to do better than inflation, or your money will lose value, okay? And basically, there's a theory in finance, and there's 3 theories, but one is called the liquidity preference theory, and it's people prefer short-term interest rates because they're more liquid, and they could get out of them quicker and reinvest versus long-term. Now, you'll always get a better return long-term, but then you'll have to buy and sell, such as a bond. So people don't want to, like, when they buy a CD, they don't want to lock their money up for a year or two, because basically then they can't get out and they'll be penalized, right? So they prefer, short-term interest rates, short-term CDs, 6 months, 3 months, whatever. Okay, so here's the supply and demand relationship. So here's the demand curve, right? Here's the demand curve. And you can see if the supply curve is up here, okay, it intersects the demand curve right here, right there. And that sets one interest rate. Now, if the supply curve should drop here, on the demand curve, that means there's basically a greater supply of money, and the interest rates will decrease. Okay, so you'll notice here now the supply has has changed, and you'll notice the interest rates have gone down where it crosses the demand curve. So there's always a relationship between supply and demand here. Okay, so there's basically less demand here now, right? It hits lower on this demand curve. So the equilibrium interest rate will change. Okay, so there's and this has come up recently with the Fed, a thing called negative interest rates. So when a loan carries an interest rate below zero, the lender essentially pays interest to the borrower. So as you know, the Fed has lowered the interest rates to zero, and but they said that they won't go negative. And basically, why do people buy that? And this is really very practical for today, because it's a safer alternative. If you're in the stock market and you're losing like I did, I lost about $500,000. It's still a better return if you only lose, if you pay a little bit, and only lose maybe 1%. So there are people, and Japan has done this, but there are people who would opt out to basically buy and pay, have an interest rate below zero to be in safe treasuries. So as you can see here, back in 2008, and I'll read it to you because it's interesting. Near the height of the financial crisis in 2008, interest rates on T-bills briefly turned negative, meaning that investors paid more to the Treasury than the Treasury promised to pay back. And this is what's going on today. Why would people put their money into an investment they know will lose money? Remember, the 2008 saw the demise of Lehman, and fears that other commercial banks and investment banks might fail were rampant. Evidently, some investors were willing to pay the U.S. Treasury to keep their money safe for a short time. So there's a lot of talk of that today. All right, so interest rate fundamentals here. There's something called nominal and real interest rates, right? The nominal rate of interest is when you go to the bank, and that's the actual rate of interest charged by the supplier of funds and paid by the demander. So, and that's different than, so this is called normally the APR, annual percentage rate. And this is different than APY, or effective rate, which we'll talk about later. All right, so the real rate of interest is the rate of return on an investment measured not in dollars, but in the increase in purchasing power that the investment provides. An increase in purchasing power means, is it beating inflation, right? So the real rate of interest is basically measuring the rate of increase in purchasing power. Okay, so that's an important thing to know, and we'll get into that more in the chapter. All right, so here's nominal and real interest rates. So here's the basically nominal rate, and here's the real rate. Okay. And here is the expected inflation rate, I. You see that, right? So if we multiply these two, we find out that the real rate of interest is the nominal rate, and it's approximate. Everyone see that? It's simplified. This means approximately when it's a squiggle, minus 1, I. And this is from your book, okay? This is from your book. All right, so let's just go through this example and then I'll cut off. Bert Gummer is a survivalist who constantly worries that the apocalypse may happen. To be prepared, Bert stores food, and a lot of people are storing food now as you see what's going on in our crazy economy. Bert has $100 to add to his food stores, and he's considering the purchase of 100 cans of Spam. Bert expects the inflation rate to be 9%, so a can of Spam will cost $1.09 in a year. Bert's wife, Heather, has heard of an investment that will pay a 21% nominal return over the next year. So she thinks Bert should invest the money rather than use it to buy spam. And I think she's right? So basically, equation 6.1 says the approximate real rate on Bert's potential investment is 12%, right? So 12% is roughly 21% minus this inflation rate of 9%. So on the basis of this calculation, Bert might expect that if he invests $100, he can buy 112 cans of spam next year rather than 100 cans this year, a 12% increase in purchasing power. Suppose that Bert invests the money, earns a 21% rate of return over 1 year, later has $121. By that time, 1 can of spam costs $109. So Bert is just barely able to purchase 111 cans. Bert's purchasing power has increased by 11%, not by the 12% that he expected. Right? Equation 6.1 reveals that the exact real rate on Bert's investment is 11%. And here we go through this, and it comes out approximately to 11%. So here's his real rate of return. So here's the real rate of return. So it's an interesting example. All right, so I'll knock off there, okay, because I'm about 12 minutes into this now.